Hi guys, thank you so much for joining me in another video. My name is Fifi. I'm a mum, engineer, consultant living in London, and I make videos about saving money and investing, understanding the economy to make better financial decisions. I read an interesting observation this week that the majority of investors and fund managers consider themselves value investors. I found it quite interesting, mainly because it's paradoxical both in the way that managers and investors tend to behave, and also if everyone were value investors, then there would be no value left. Even in our own community, where of course we have a soft spot for tech and growth stocks, we seem to equate 30 times earnings, i.e. up to 30 times more than what a company earns, and consider that a value stock. But one of the surprising things is that we even have stocks with PEs of 1,000 but still get the justification that the stock is undervalued, mainly because the market doesn't understand the potential, and that being the unlocked value of the EV. You've probably guessed which stock I'm talking about. But the point here is not to slam the valuations, but instead explain that it's not really value investing. In fact, true value stock pickers have badly lagged the market. This is the strict definition of looking at companies that are cheaper than PEs and price to book ratio. That being said, we still want to sell the story that we are shrewd, so we understand the fundamentals and are good at picking the bargains, while on the contrary we like to buy firms with momentum, growing quickly and rising share price. Being honest with ourselves and redefining how we think about value can make us better investors and deploy our capital more effectively. Also, given the dominance and growth of the FAANGS, if you know me then you know I love the FAANGS, a portfolio that doesn't have exposure to these stocks or even to the FAANGS can be very risky, but that doesn't mean they need to be called value plays, right? Call a spade a spade. The tragic truth is we don't. Instead, we try to estimate a firm's intangible assets. So what are intangible assets? Well, an intangible asset is an asset that a company owns that isn't physical. So back in the old days, the majority of assets a company owned were physical. So all your accountants out there will recognize the PPE from your trading, so the plant, property and equipment, otherwise known as tangible assets. However, as the time has gone on, intangibles now make up a greater portion of the balance sheet or assets of a firm. The issue with intangible assets is how they pass through the company account. So some are easier to feel and see: brands, copyrights, patents and intellectual property, and these are captured and treated as legal property, so do have value. However, the money that is spent in creating and also maintaining these intangible assets, which pass through as an expense, whereas if you improve a physical asset, these are recorded on the balance sheet directly. Now, the only time intangibles are measured is when a company changes hands, and that is often called goodwill. The goodwill is the excess that is paid at the point of an acquisition between the company's fair value and its actual price paid. So let me give you an example. For instance, when I sold my restaurant back in January this year, we received a price over and above the value of the lease, but that included things like our brand and our reputation in the market, all of which will help the new owner to continue to derive a better cash flow from the restaurant asset. But the interesting quirk is often buyers overpay for goodwill, and that is because it's the setup of the negotiation, and also perhaps the buyer sees an upside and factors in their future perception of the goodwill. So the point here that I'm trying to make is that book value does a bad job of capturing the true value of what a company is worth, and it's not just in tech but also for other sectors. Examples such as Unilever or Johnson & Johnson and even Disney that have done a phenomenal job in extracting value from the intellectual property and developing the intangible assets. So where am I going with this is the question, and if you've still hung around for all of this, well done. When investing, you should consider that a firm's assets are only worth something if they produce a profit. That's how we should look at tech stocks too. So look for a cash generating core business and belief that will continue. And the successful tech companies, if we look at them individually, have built consistent revenue streams from advertising and continue to innovate by hiring the smartest people in the world. Will it continue? Probably. So shall we hold these companies? Yes, on that basis, but let's not kid ourselves, right, that it could be a value stock. Now, I just come across another YouTuber in our community I really like. His channel is called Financial Lift, and he has a video called The Endowment Effect. It's fascinating and provides the economic theory of what we have technically discussed in this video. As you know, I am all about the facts, and his channel covers the theory with plenty of facts. I'll leave the link to the video down below in the description. Check it out if you like, but his channel has a great selection collection of topics which are fresh. So guys, I have done quite a few videos on tech now, given how much of our global performance is coming from tech. So click here and here if you want to know more about my obsession with the man that is Jeff Bezos, and a couple more gems from my tech collection. But till next time, cheers guys.